I want to start on the FICC trading picture, which looks to be pretty strong compared to the competitors, down 11%, I read, on FICC revenue in the reporting period, which seems to be a better performance than some on Wall Street managed to turn in. What does this tell us about the strengths of that part of the bank?
Look, we have a portfolio of strong businesses in FICC. And while we did see the normalization of activity in product areas like rates and FX in particular, our relatively strong credit businesses, both flow trading, distressed trading particularly, performed very well in the quarter, and you see that coming through then in our relative revenue performance. And so what does that tell us about the path ahead from here then, James? I mean, trading has been slowing in some areas, but you point out various parts of that strong performance that you reported. So what can you tell us about that normalisation and the path ahead? Well, we and the others in the industry have been calling for a normalisation. We have been seeing that now successively over several months. Because there is a portfolio of strong businesses we have, rates, credit, FX, emerging markets, what we tend to see is weaker performance in one area is offset then in other market conditions by stronger performance in a different area. So we feel very comfortable, to your question, Anna, about the forward, because the market environment that we see going into the second half of this year and into next year is one that we think is still constructive for the businesses. And we see a high degree of client engagement around our offering, our capabilities. And you've upgraded your revenue guidance, I think, for 2022. Can I get a bit more detail from you, James, on what's driving that? What gives you that confidence? Well, look, we've implicitly updated our revenue guidance for 2022 because the numbers that we shared with investors in December for each of the core business units, they're either running in line with or ahead of. That gives us real confidence going into next year. We also see much less of a headwind, even in today's interest rate curve, relative to what we had planned on as far back as November, December. So we see really bullish signs for performance above the 24.4 billion that we called for 2022 when we shared those numbers with investors in December. That's enabled us to essentially recognize some uncontrollable costs that are likely to repeat into 2022 to do with the Single Resolution Fund assessment and also a bank deposit insurance levy here in Germany. And so we feel really strongly about our ability to offset those uncontrollable items while reaffirming our targets for next year, an ROTE of 8% for the group and a cost-income ratio of 70%. And you indicate today provisions for credit losses down 90% year on year, which, given the year that 2020 was, might be expected. But how do you expect those kinds of numbers, those provisions, to evolve? So look, not to utilize the word normalization, clearly the 7 basis points provisions against loans that we've been running at for the first half of this year is unlikely to be sustainable in the near term or even in the medium term or even near term. What normalized CLPs looks like for us at this point is still hard to tell. The credit environment has been remarkably strong, I think, to even surprising to us, and we were quite bullish and confident about credit. We're now calling for a 20 basis point for the full year CLP level relative to loans. But even that, we think, would be conservative if present trends persist. And we could see this environment lasting into 2022. Let me ask you a little about the costs and the cost side of the business. You've had some recent headwinds in that area, and you've given us some new targets around some areas of costs today. Where does this leave targets for costs for 2022, for example? Well, look, we're going to target off of the cost-income ratio now, which we think is much more appropriate for our company going forward. You know, we've come a very long way in the transition of Deutsche Bank, and we can now, I think, be making better decisions for the future if we're thinking about the business on a margin basis. And as we have been working to variabilize our expenses, we think it's a more appropriate measure. In absolute terms, clearly we're indicating that the 400 million of uncontrollable expenses will fall through next year, essentially to the bottom line. We don't want to constrain investment spending to offset those expenses, given, again, they're out of our control, but they also have an end date in 24 and 25. So in a sense, they're temporary. But as you say, we also see bullish signs in our business, especially about volumes and revenues, that will carry some cost with it, but we're working to execute on measures to offset those incremental costs, and of course execute everything that underlay our original 16.7 billion target, every measure that led to those numbers.
I wonder what kind of pressure you're seeing on wages at the moment. We recently reported that you boosted junior banker pay. What are you having to do in that area to keep up with the competition?
Well, look, we operate around the world in a number of businesses and a number of markets, and in each of those markets there's a labor market. We obviously aim to hire the best talent. To do so, we have to pay competitively. And as you say, in certain areas there have been adjustments necessary. In some senses, in some markets, a catch-up after some years of relatively stagnant pay. And in other areas, there are different dynamics, but we certainly see some inflation of our labor costs, as you point out, in parts of the business.
There's a lot of conversations taking place in the sector, in the industry at the moment, about where people are going to work from in the future, James. I wonder what thought you're giving to that at Deutsche Bank. I wonder when you're bringing people back to the office and how. Are you offering sort of hybrid models? What's the latest offering?
Yeah, so we have decided to go down a hybrid path, and we've now actually launched that program in terms of employee communications and implementation, sort of site by site and business by business. In principle, we're prepared to have the flexibility to allow people to work from home 2 to 3 days a week. It very much depends on the activity the individual is engaged in. Some activities don't lend themselves to working from home at all for control and other reasons. But we've now kicked that off. As I say, each function and division is working to implement that with specific, essentially, agreements with employees when they're expected to be at the office. And to your question, Anna, about when we're implementing that, as each location returns to office based on the local authority's guidance, that's the point at which we'll implement that hybrid or flexible working scheme for that location.